On August 25th, Oklahoma voters will see State Question 844. The language sounds technical, but the question is very practical. Oklahoma would keep the 5-year ad valorem tax break for qualifying businesses. The uncertainty is whether the schools, counties, and local services that lose that property tax revenue will continue to be made whole. The tax break stays. The question is who eventually gets the bill. Under current law, the company receives the exemption and the state reimburses the affected local entities for the revenue the state policy removed. State Question 844 would not repeal the corporate exemption. It would give future legislatures more authority to decide reimbursement levels and methods. That is the risk. The company gets certainty. The community gets a promise to be determined later. The key phrase is levels and methodologies of reimbursement. That language does not guarantee 100% reimbursement. It does not create a minimum payment. It does not give voters the replacement formula before the vote. The official fiscal statement says the effect is unknown because it depends on what future legislatures decide. That is the uncertainty hidden inside the ballot language. This is the concept voters need to understand. Reducing reimbursement does not reduce the corporate tax benefit. The company would keep its 5-year exemption. The state would spend less. The school district, county, and local public services around the project could absorb more of the loss. The subsidy does not shrink. The bill just moves. The latest Oklahoma Tax Commission report lists about $88.6 million in total statewide reimbursement. Google LLC Myall LLC alone accounted for about $34.2 million in Mays County. That is not an argument that Mays County is doing something wrong. It is an example of a state-created tax break becoming a large state budget obligation. If reimbursement is reduced, the tax break remains and the local community becomes more exposed. The exemption is usually described as a 5-year tax break, and for a particular asset group that is generally right. But a company that keeps adding qualifying buildings or equipment can place new assets into new 5-year periods. Google's Mays County listing shows property in years 1 through 5 at the same time. That does not mean the same server is exempt forever. It means new eligible property can keep restarting the clock. Before deciding who should pay for an exemption, Oklahoma should ask whether the exemption was needed at all. That is the but-for test. Would the project have happened here without the tax break? The state's own Incentive Evaluation Commission, with analysis prepared by PFM Group Consulting, found the program may not perform well on that test. It also lacks an annual cap, and Oklahoma does not collect enough project-level data to know exactly what taxpayers bought. This is also part of Oklahoma's larger economic development problem. Being affordable can be an advantage, but being cheap is not the same as being competitive. Strong state economies also attract employers with educated workers, infrastructure, health care, workforce training, and good communities. When Oklahoma keeps using tax breaks to compensate for weaknesses in those areas, it drains resources from the very things that would make the state more competitive. House Bill 2992 created data center ratepayer protections. The principle was simple. Families and small businesses should not pay for major system upgrades driven by massive power users. That is cost causation. If the customer creates the cost, the customer should carry it. The same question belongs in the property tax debate. If a project creates costs for roads, water, schools, and emergency services, why should the tax break be protected while local reimbursement becomes uncertain? Google is the example, but not the only risk. Any community recruited to host a capital-intensive project could face this question. Large industrial facilities can require roads, water systems, emergency services, and school planning. Local leaders may be told not to worry because the state will reimburse the lost property taxes. State Question 844 makes that promise less secure. The corporation negotiates before it invests. The community cannot renegotiate its obligations after the project arrives. This risk becomes most important when Oklahoma faces a budget shortfall. The state has to balance its budget. Raising new revenue generally requires a 3/4 vote unless lawmakers send the issue to voters. At the same time, federal Medicaid and SNAP changes can add pressure. and the private school tax credit is capped at $275 million. In that environment, cutting an obscure reimbursement program may be politically easier than raising revenue or cutting visible services. A no vote on State Question 844 does not repeal the 5-year ad valorem exemption. It preserves the current state reimbursement responsibility. That gives lawmakers time to ask the right questions. Did the incentive actually cause the investment? How many permanent jobs were created? What other subsidies were stacked with it? And will the local community be fully protected? Oklahoma should review the tax break before it moves the bill. State Question 844 gives companies certainty and local communities risk. Until lawmakers disclose the replacement formula, guarantee full protection for local services, and prove the incentive is necessary, Oklahoma voters should say no. Review the tax break before shifting its cost to schools, counties, and the communities asked to host these projects. Vote no on State Question 844.